Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about pullbacks versus breakouts. So, if you've been attending these classes, as I'm pretty sure the regulars have, you must have heard me talk a multiple amount of times about trading with trend trading strategies. Okay, and basically, when you're trading with trend trading strategies, there are actually just one of two ways you could really take advantage of them. Or let me put it this way: there are two main ways, broad categories, that trend traders tend to take advantage of trending markets, and that's usually using either one of these two methods that we're going to be talking about today, which is breakouts or pullbacks. Okay, so both of these trading methodologies or trading styles have their pros and cons, just like with anything in trading. And so we're actually going to be talking about them, and then we're going to be looking at a couple of examples of what they look like on the charts. And more than anything else, we're actually going to be talking about how you can reconcile both of them to take advantage of them in a way that a lot of traders don't know how to do. Okay, so without any further ado, let's dive right into it, shall we? So, moving on. What are breakouts and what are pullbacks? Again, like I just told you, if you've been attending any of these classes, you must have heard me talk about trending markets a ton of times. And that's because trending markets are one of the easiest market that inexperienced traders or beginners or traders who are struggling to make a profit trading the markets use to take advantage of the markets. Okay? So the anatomy of a trending market is characterized by the formation of higher highs and higher lows, which would look something like this in an uptrending market, or the formation of lower lows and lower highs, which would look something like this in a downtrending market. Okay, now let's quickly clean this up, and then let me do this, and then take this off, and this one. Okay, so what do I mean by higher highs and higher lows? So here's the thing. Okay, when the market is in an uptrend, what you're usually going to find, the way price moves during an uptrending market is going to be depicted by the formation of price, let's say starting from all the way down here, which for this particular example would be our origin low, okay, which is the point where the move we're referencing started from. Okay, so let's say this is our origin point and this is the low, and so price moved from this level and then it moved up all the way up to this level. But then when it reached this level, it actually couldn't move any further. This does not mean that the up move, the bullish move is over altogether. It just means that, just like you'd see a runner, for example, let's say a marathon runner, okay, would run for a bit, and then he's likely going to either reduce his pace just to catch his breath, or maybe even take a little bit of rest to re-energize before he continues his run. This is kind of what you're looking at on the charts, because when the bulls push prices up, the price is actually going to reach a level where it's going to find it difficult to continue moving up, not because they are completely or totally exhausted, but because they are kind of pausing for a bit and catching their breath before they make another strong move to the upside. Okay, so here's where it gets interesting. Okay, what usually tends to happen when this occurs is that you're going to see price hit this resistance or some sort of resistance on the chart, and then it's going to pause for a little bit. So let's label this area as our low point. Okay, so I'm just going to spell it out this time, but from here on out, I'm just going to be using the letter L to show our low levels and the letter H to show our high levels. Okay, so let me write the high just for now. Okay, so this is our low point and this is our high point, where price reached and then it's struggling to continue moving up. Now, when it reaches this level on the chart, what usually tends to happen is that price is either going to start consolidating, maybe struggling to continue moving up and then just moving around in and around here, or it's going to pull back a little bit. What's going to differentiate this pullback from a reversal is that for a normal pullback that occurs during a trending market phase, that pullback is usually not going to go all the way down to the origin point low we had. So for example, if you're thinking that this market is beginning to trend to the upside, and then all of a sudden when price reached this resistance area and it started pausing, showing us like it wanted to pull back, but then that pullback that it started to do went all the way down here and even broke below this low, then this is no longer a healthy uptrending market. Okay, so in this case, you would not want to be involved in taking any trades in the direction of the supposed trend, because the trend has the market structure for an uptrending market has been invalidated. Because usually what tends to happen is the market structure for an uptrending market is going to be characterized by, like I told you earlier on, the formation of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. If for whatever reason price invalidates these higher lows, breaks below them, that's what I mean, then we are no longer in an uptrending market, but rather maybe a reversal or a temporary stalling or consolidation. Okay, so moving on. So let's say this was our origin low, and this is the high where price couldn't move any higher, and then it started to pull back. It started to reverse a little bit. Now, what you're usually going to find next is that if this is truly a healthy trending market, price would have no business breaking below this low, which is the first thing we talked about. And then when this pullback reaches an area that it finds it difficult to break below, then price is usually going to gather enough momentum to not only move up to the previous area where it got rejected at, but it's even going to break above that level to form a brand new high. Okay? And this is where that naming convention that you heard me talk about usually comes into play. Because when you hear me talk about the market anatomy of an uptrending market being the formation of let's say higher highs, okay, which is HH, and then higher lows, which is going to be HL in this case, okay, and then the same thing, higher highs and higher lows. Usually, this phrasing didn't just come out of nowhere. When you take a look at this particular example that I'm showing you here, you notice that this was our origin low point, okay? Now, when you compare this low, which was the end of the pullback that price made, okay, after it hit this resistance area, this rejection here, you notice that this is a low level, but it's not as low as this previous low. And that's the reason why this is called a higher low, because relative to this origin low, this is actually higher than this low. And then the same applies to this high. This was the area where price was struggling to break above resistance. And when it started to get rejected at this price level and it made this pullback, it led to the temporary formation of this high. Okay? At that point, this price action didn't happen. Now, the thing is, when price gathered enough momentum to break above this resistance area to form this high, then this particular high, when you compare it to this previous high, it's actually a higher high relative to this one. And that's where that whole naming convention of higher lows, remember, this was our low and this is another low. But this low is higher than this low, and that's why it's called a higher low. This is a high, okay, and this is another high. But when you compare this high to this previous high, this is a higher high. This is where the naming convention of that higher highs and higher lows and higher highs and higher lows got their name from, okay? This is for a typical healthy uptrending market. This is usually the direction of price action that you're going to see. Now, for a downtrending market, the opposite is actually the case. Because for a downtrending market, price is usually going to be forming lower lows and lower highs. Okay, so let me quickly clean this off of the charts so that you see exactly what I'm talking about. Okay, let me quickly do this. Just a moment. I'm taking my time to explain this to you because without this foundation, you're actually going to find it difficult to understand what we are going to be talking about in today's class, which is the breakout and the pullbacks. You need to understand market structure and the anatomy of a trending market before what pullbacks are and breakouts are would actually make sense for you before you'd even move on to knowing which one of them is better for you to use to trade with. Okay, so this is quite important, and that's why I'm taking my time to explain this to you. Okay, so for a downtrending market, what you're usually going to find is, for a healthy downtrending market, you're usually going to see the formation of lower lows and lower highs. Lower lows and lower highs. This is usually going to be kind of like the market structure of a downtrending market, in theory, okay? Now, when I show this to you on the chart, remember, let's assume this is our origin point where this whole price action move started from, okay? And so this particular origin point, let's call it our high, okay? When price moved from this high and then it came all the way down here, it found it difficult to continue moving down. And so it led to the formation of this low price level. But then when price reached this level and it found it hard to continue moving down, we had kind of like a retracement or a reverse or a correction in price action. If this was the impulse wave, this was the corrective wave. Okay? And so when this corrective wave, when price rejected this area and started moving up, if this was not a healthy uptrending market, then price would not have made its pullback be contained within this area. It would have, for whatever reason, broke above this previous high, and this would show us that this is actually not a healthy downtrending market. Okay, but for the fact that price found it difficult to even reach this previous high level, to even make an equal high, this is telling us that, okay, it looks like this is really a downtrending market. Because what does the price action of a downtrending, the anatomy of the price action of a downtrending market, what does it look like? Well, it looks like price forming lows, okay, and then lower highs and lower lows and lower highs. Now, this is a high and this is another high. But when you compare this high, okay, this high to this previous high, this one is actually lower than the previous high. And that's why this is called a lower high, LH. This is our low level. And then this is another low level. When price broke below this low, it led to the formation of this low. Now, because this low relative to this low is actually lower, this is going to be called our lower low, which I'm depicting here with LL. Okay? Then when price got rejected at this level, it led to the formation again of this high, which is, compared to this previous high, a lower high. Okay? So, in essence, the anatomy of price action for an uptrending market is characterized by the formation of higher highs and higher lows continually, as long as the trend is healthy and it remains intact. If the trend, for whatever reason, is no longer as strong as it would appear to be on the chart, then price is going to find it extremely difficult to continue breaking below this low, in the case of the downtrending market, to continue breaking below the low to form a lower low. But then we're going to now start see price struggling to break below the low and maybe even forming equal lows, and then reversing all the way to, altogether and breaking above the lower high to now either start consolidating or start forming the market structure of an uptrending market. Okay? So with that out of the way now, we've laid down the foundations to talk about breakouts and pullbacks. And that's exactly what we're going to do. Okay? So moving on. Now, using this chart as an example, this is the chart of the USD JPY currency pair. Okay? You would notice that price was actually price was moving down. Let's just say price was moving down. Okay? It was deforming the market structure of a downtrending market from somewhere around here. Okay, so let's assume this was our origin high point. But then when price moved low, okay, it came all the way here. It got rejected because it was struggling to break below this area. And so it got rejected. You can see the formation of this long wick for this candle, okay? So it got rejected in and around here. And then it moved all the way up here. But then it couldn't keep pushing any further up to form a high that was above this high. And so this would have been our high. This would have been our low where price got rejected. And then this would have been a lower high. Because when this high was formed, price was struggling to break above this high. And it just couldn't break above this high. Okay? And so this would have been our lower high. And this would have been our higher high. But then watch closely, because this being our low point, price now came all the way down here and broke below this low. So in a nutshell, price now started forming the market structure of a downtrending market, meaning which is characterized by the formation of lower lows, okay, because this low is lower than this low, and lower highs, because this high is actually lower than this high. Again, this price got rejected at this level, and then it formed this high, which compared to this high is actually lower. So this is also a lower high, and then price eventually broke below this level where it was struggling to break below. And so you can see clearly this is the market structure of a downtrending market. Lower lows and lower highs. Lower lows and lower highs, okay? Price continued doing this. Now, if you remember, I told you just moments ago that as long as price continues in the downtrending market, as long as price continues to form lower lows and lower highs continually, then that downtrending market is actually, the trend is intact. But then trends don't last forever. As you probably have found out in the market, trends don't last forever, no matter how strong they are. So there's going to come a point in time where the sellers who are pushing prices lower are either going to run out of steam, or they're just going to start profit taking, which would eventually lead to the formation of the market structure, which is not in line or not typical of a downtrending market. And what do I mean by the market structure which is not typical of a downtrending market? You see, if the market is intact, the market trend, that's the downtrending market, if the trend is intact, price is meant to continue forming lower lows and lower highs. But you can see that even though price was forming lower lows, the lower highs were now increasingly getting closer and closer to the lower highs, okay? And then the lower lows, all of a sudden, after price printed this low, it couldn't even continue printing lower lows. And then this high that was printed is no longer a lower high, because this high is actually higher than this previous high. So we've now moved from forming the market structure of a downtrending market, which is characterized by the formation of lower lows, lower highs, lower lows, lower highs, and lower lows and lower highs. All of a sudden, price is now breaking above the lower highs, and it's struggling to continue forming lower lows. And so we moved from forming the market structure of a downtrending market to now forming the market structure of an uptrending market, which is characterized by the formation of higher highs and higher lows, higher highs and higher lows. This, I explained the theory for you using illustrations and just doodles on the chart, on my board with a pen, okay? Now I'm showing to you practically on the live charts, okay? Now, what does this have to do with anything? Well, breakouts are one of the ways that traders use to take advantage of trending market conditions. But what are these breakouts actually? What are they? Okay. Now, when you look at this chart, for example, going back by this example that we were talking about, when price was forming the market structure of a downtrending market in and around here, where it started from this level to this level, okay, ideally, you would see that this is actually a level where price got rejected, this support. Because when price moved from this high to this low, and then it moved up, it was struggling to break below this area. But the typical trend trader, his mindset, what he would have been thinking at that point in time would have been that if this trend is really a downtrend, then at some point in time, price should be able to come to this low level and break below it and continue moving in the direction of the predominant market trend, which is the downside. And so for a breakout trend trader, he's actually going to be waiting or looking to take a short trading position after he must have established the direction of the trend. Since price was forming lower lows and lower highs here, he would have been waiting for price to break below the low and then to continue moving to the downside, because if it's a downtrending market, then price has no business whatsoever moving away from this, okay? So price should break below this area and continue moving to the downside. So this is actually the breakout side of things. For a breakout trend trader, he's actually banking on the fact that price is going to, at some point in time, reach that level of resistance or support where it got rejected from, and then break either above or below that level to continue moving in the direction of the trend if indeed the trend is healthy. That is the breakout trader, and that is his mindset. Okay? Now, what about the pullback trader? For the pullback trend trader, he understands and he knows that price is going to break below or above the level where it got rejected at to continue moving in the direction of the trend. But he also knows that price does not move in a straight line. He understands that price is going to, in a downtrending market, form a low, and then form a lower high, and then form a lower low, and then form a lower high. So instead of acting like the breakout trader and placing a trade when price breaks below the level or above in the case of an uptrending market, for the pullback trader, he actually wants to get, he wants to squeeze out more profits from that trading position. And so instead of just jumping on the trend when the breakout occurs, he is going to wait for price to make that pullback and then show him signs that the pullback is over for him to get into the trend, for him to get into the market with a trade in the direction of the trend, trying to milk out as much as he can as possible. Both of these approaches are valid. Okay, both of them also have their pros and cons. For the pullback trader, for example, when you wait for a pullback to occur, there are times when the pullback might not be deep enough, and so the market might just break out and continue moving in the direction of the trend, leaving you waiting for a pullback that never occurs, and then you basically miss out on the trade. But for the breakout trader, there are times when you're also going to get faked out because price would appear that it has broken above or below the level to continue moving in the direction of the trend, only for you to find out that that breakout is a fake out. Now, this doesn't mean anything because if you've been following these classes, you know that I always like to tell you guys that trading is a game of probabilities. And so we're not trading in such a way that we're expecting to win 100% of the trades we take. And that's why risk management is important. That's why, in fact, we want to trade in such a way that even if we were to lose more trades than we win, because of keeping our risk consistent and trading with positive risk to reward ratios, we're actually going to have an edge in the market that is going to make us profitable in the long run. And so just because you're going to lose a couple of trades here and there does not mean that the method or the technique you're using to approach the markets to trade, to approach trend trading is actually bad or it's good or whatever the case might be. Okay, so these methods, both of these methods have their pros and their cons. And I told you that I would actually want to show you a way where you can marry both of these methods so that you can take advantage of them. And that's using multiple time frame analysis. So what does this mean? Let me quickly take this off of the chart and explain this to you in details. Okay. So when I delete this and I delete this, and then I'll delete this quickly. Okay, let me quickly take this off here. And this one also. So I want you to recognize something, okay? You see, when the market is in a trend, for example, you've established by market structure that the market is in a trend, either an up or a downtrend. We've used this downtrend as an example. Now let's use the uptrend movement. When did we know that this market is in an uptrend? When it's struggled to continue breaking below the lows and to continue forming lower lows and lower highs. And then all of a sudden, it now started struggling to break below the low, and it started forming a higher low, and then it started breaking above the lower highs to start forming higher highs. Automatically, from this price action that we had here, we've shifted from forming the market structure of a downtrending market to forming the market structure of an uptrending market. Now, one thing that's for sure is that when you see this move, for example, this is the 1 hour chart, you know that this is the market structure of an uptrending market. But then, for a true trend trader, you also know that within this level where price now started getting rejected at, you see this pullback that you're seeing here, you understand that on the lower time frame, this pullback is going to look like price forming lower lows and lower highs on the lower time frames. So let's go to the, I've mapped out this area here, and then I want you to pay close attention to this area on the chart, okay? Let me quickly pick this, and then we'll go down to the 5 minutes time frame, okay? So when I do this, okay, let me quickly delete this. Aha. You see, this was what I was telling you. You see, on the 1 hour chart, this pullback that we had was just looking like, okay, price was just going down. But then now that we've moved to the 5 minutes time frame, which is like zooming in to really see the price action, you can see that on the 5 minutes time frame, this down move that we just saw, like a couple of candles on the 1 hour chart, is actually the formation of a market structure of a downtrending market on the 5 minutes time frame. So price is now forming lower lows and lower highs, lower lows and lower highs, lower lows and hopefully lower highs. Okay, but then we understand that this is only temporary because this is the lower time frame and the higher time frame is actually in an uptrend. And so the pullback trader would, the smart trend trader, I would say, not the pullback trader, the smart trend trader would understand that on the higher time frame, which is stronger, we're actually having the market structure of an uptrending market because price is forming higher highs and higher lows. And if for whatever reason price does not break below this lower portion of this gray area that we've charted, then we are maintaining the market structure of an uptrending market based on the higher time frame. But on the lower time frame, this pullback that we have is a temporary retracement on the higher time frame. So the way we can use this to our advantage is that we would wait for price to now stop forming the market structure of a downtrending market, which is this pullback that we have here. And then when it, for whatever reason, breaks above this lower high and struggles to continue forming these lower lows, then at that point in time, we understand that, okay, it's likely that the bullish trend that we have on the higher time frame is now resuming into the market again. And so you've married the market structure of an uptrending market on the higher time frame with the retracement or the correction on the lower time frame. Okay, and now you've gotten a better entry because now that you've seen that price has moved from forming the market structure of a downtrending market, which is lower lows and lower highs, to now breaking above the lower high and then pulling back and then getting rejected here, you could take this trend, this trade, this bullish trade, okay, based on the lower time frame, getting in and around here. If you are using a aggressive stop loss, then your stop loss would be just below this area, okay, and then you'd be aiming for a 1:2 or 1:4. But if you want to use the conservative stop loss approach, you could place your stop loss below this area. Why? Because if for whatever reason price is able to break below this low, then this downtrending market structure is not over again. Okay, so just place your stop loss here and then aim for whatever risk to reward you aim for, maybe 1:2, 1:3, or whatever the case might be. The goal for me with this is that I'm showing you, as a smart trader, you can marry both of these techniques together. Meaning, if you see that price is making the market structure of an uptrending market on the higher time frame, and then we start forming pullback on that higher time frame, you can zoom into the lower time frames so that when you see that the market switches from forming the opposite market structure, which is on the higher time frame, on the lower time frame, and then it makes a change of character, you understand that now the trend is likely to continue moving in the direction of the higher time frame's trend, which is exactly what we have here. Because on the lower time frame, on the 5 minutes chart, let me quickly do this. Okay, on the 5 minutes chart, you can see that we clearly went from forming lower lows and lower highs to forming the market structure of an of a bullish trending market, which is higher highs and higher lows, and we took this trade here. Okay, but then when we move to the 1 hour chart, this is clear for you to see, because you can see that we went from forming the market structure of lower lows and lower highs to now forming higher highs and higher lows. And this pullback that we saw, which on the 1 hour chart is just like, a couple of candles just going down. On the lower time frame, it was clearly the market structure of a downtrending market. And then when we had the change of character, we took that trade and look at what resulted. A clean 1:3 trade. So you can marry both of these techniques together. It's not necessary that pullback trading is better or breakout trading is better. You can join both of them with multiple time frame analysis, so that on the higher time frame, when you have the market structure of one trend, you go to the lower time frame and then wait for a pullback. And then when you see a change of character, you now take the trend or take the trade on the lower time frame, because you're hoping that that trend is going to continue on the higher time frame to form a brand new high. So this is how you can marry both of them together. Okay, so again, this really much brings us to the end of this week's edition of the class. And I sincerely hope that you got value in it. You understand exactly what we explained here, because this is one of the concepts that is going to help you to become a consistently profitable trader. It's an advanced technique, okay? Because you're using market structure, you're using price action and breakups, all of these things together with proper risk management to improve your profitability. And trading is all about increasing your edge and increasing your the things that would help you to become a consistently profitable trader. Okay, so again, if you have any questions, please feel free to reach out to us on the comment section or any of our social handles. And then before we wrap up the class, again, I'd like to use this opportunity to invite you guys to take advantage of our ITU Forex bots, which are designed to take advantage of low risk, high probability trading opportunities in the market, place those trades on your behalf with proper risk management and proper execution, even if you're out there doing things, doing other things with your time. So if you're interested, please reach out to us on the social handles and we'll be more than happy to help you set everything up step by step. Once again, thank you, and I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week. Cheers.